the food order process can be made really difficult if it was made as a process in banks have been made.
Hi, my name is Leo Vaskelainen, Head of Banking at Siili Solutions, and welcome to our Composable Banking podcast, where we discuss the expectations and reality of changing banking landscape. Joining us today is Mikko Ayub, Distinguished Senior Advisor at BearingPoint, a former CEO of Aktia. With comprehensive board experience, Mikko holds multiple board positions and has recently appointed to the board of LähiTapiola. Welcome, Mikko.
Thank you, glad to be here.
Our second guest, esteemed Erik Åkesson, Senior Business Advisor from BearingPoint, whose extensive top management journey spans notable institutions such as Danske Bank, Nordea, Royal Bank of Scotland, and HSBC.
Thank you.
With these accomplished individuals, we promise to go through together three major points. What is happening in the market, shed some light on the challenges and opportunities the Nordic Bank is facing, and at the last point, share some best practices and solutions how to prepare for the future. We're delighted to have you here and very pleased that you're here. Thank you. You both are from BearingPoint. Would you, Erik, share a couple sentences about BearingPoint? What do you do?
Yeah, sure. We are a tech consulting management company, and we operate basically in the intersection between business, regulation, and technology. Wherever these fields meet, there will be challenges that needs to be solved, and that's where we operate. We also do many other things, but that is what we do best.
Fantastic. And if we jump straight away to the existing market situation, we're finalizing the 2023. All the banks are finalizing pretty much their strategies, looking into 24 and so forth. But if we look at the market right now, Mikko, the net interest income experienced robust growth, investment returns were strong, costs were well managed, etc. A lot of things has happened in the banking right now. So in the short, you could say that the Nordic banking sector is currently doing quite well, wouldn't you say?
Yes, I would say banking is back in business again, so to say, after an extended period of zero interest rates and negative interest rates. Good old traditional banking is back again. In the Nordics, in other countries also, but yes.
That's good to hear. It's very glad to hear that. And building the bridge towards the kind of the next year and maybe next 10 years, I heard that you wrote the white paper, if it's correct.
Yeah, that's true. Mikko and I knocked our heads together and did some thinking about sort of the medium to long term. What will the Nordic banking, or rather finance, but more specifically banking landscape look sort of 10 years from now? Mm-hmm. We decided to go for the 10-year perspective because 5 years is simply too short. If you ask head of development in any major institution, you can ask them what they do now, and that's what things will be like in 5 years. If you choose 20 years, it becomes dreaming, and we'll be saying 10 years is a little bit of a good, far enough to be forward-looking, but near enough to be sensible. And with banking, we understand broadly financial services that distributes to the masses. So in that sense, banks will share many challenges with asset managers and insurance.
One more question about the white paper itself. How was the white paper prepared? Who did you interview?
Yeah, well, that's a good one. We started off internally by gathering a team of knowledgeable people, and then we set out to interview over Teams and physically. We made sure it was a broad Nordic representation. Iceland was not included, but apart from that, it was from all the 4 Nordic countries. We had CXO people, so CEOs, CIOs, CFOs, a broad selection of that. We had regulators, we had system providers, we had startup entrepreneurs, so the kind of people that believe they will transform the business, or what else did I miss?
Analysts.
Equity analysts that observe the industry. So we believe that we have a sort of a broad aggregation of knowledge from different countries, different perspectives, and different backgrounds, and different sort of motivations for being in banking, I would say.
That's very intensive kind of a scope of people that you managed to interview.
Yeah, we even interviewed the military staff, generals, people that think about defense and stuff like that. We try to broaden out.
That's interesting. And based on that interviews, what kind of people lead the Nordic banking right now?
I think what we come across is highly competent people, highly professional people. If we look at startups and fintechs and the challenges, they typically have a quite narrow approach into what they are doing, which is understandable. They are very enthusiastic at what they are doing, and they have a very strong belief. Well, obviously, otherwise they wouldn't be doing it. That is what we see when we talk to C-level managers and board members. Then we tend to come across the fact that they do understand what is the challenge for the industry, and they do understand what is the medicine. It is just how to do it. And when we talk to equity analysts, it comes across quite strongly that banks and financial sector are dividend stocks, that whatever they do, they should secure the dividend flow to investors.
That's really interesting. What was kind of the main driver behind this? Like, what was the idea, or kind of the perception or the ambition behind this? Like, you just wanted to know what is happening out there, or how did kind of got the spark?
Well, apart from, of course, banking and finance being very close to the hearts of both of us, then what made it interesting is that if you look backwards 5 or 10 years ago, there was a lot of talk of how disruption is going to reshape the industry, and that did not happen, not certainly as it was forecasted. So then the question is on the table, what's going to happen during the next 10 years? Is it going to be just as it is, or is there going to come something else that is going to reshape the business? And we started spinning around ideas about this, or are spinning around ideas over this topic, and got excited about looking a bit deeper.
What kind of a disruption are we talking about? What were kind of those disruptors, if you just give a couple examples of those elements of disruption?
Yeah, I think back in the day, 10 years ago, both Mikko and myself were in banks. At least personally, I had a fear that banking would be dramatically disrupted by startups. I have been a startup entrepreneur myself, and so I know what it's like. You then underestimate sort of the importance and how actually complex banking is. Banking is so complex that you cannot simply easily disrupt it with one garage firm or even a big one. Then it is systemically important for society. So there are very conserving forces around this that will not allow for risk-taking in the sense. And I think most of us should be quite happy about that, because we want our money to be safe. Then you have the fact that it is very capital intensive, so you cannot just do it like that. And if you run a technology on the side that is promising, it can have a use case for a few, and regulators will sort of let it have that life with limited or slightly less scrutinizing it from a regulatory perspective. But the moment when they actually reach the critical mass to where they would have general importance for the average consumer, then regulators will start to demand of them the same oversized amount of compliance people, money order controls and everything else. And then their cost base will raise dramatically too. And so it became basically difficult for them to have this replacing effect that they hoped for. What we saw instead was that it was more efficient to team up with banks. And I think, Mikko, in that sense, you could say maybe that they, in a way, became, as a bank, you could simply let the true new thinking happen outside. You would let them do the innovation and then buy the successful ones, or how would you do that?
That is exactly what happened, rather than that the guys and girls from the garage came and took and revolutionized the whole market. What is also good to keep in mind when looking back for 5 to 10 years is that the big techs, the Amazons, the Googles, the Microsofts, the Elon Musks and the likes of the time did not enter banking. They did not enter big-time banking. One reason can be that interest rates were zero and even negative, so it was not really as attractive business, and those companies perhaps got a better return on investment in some other areas than banking. So we didn't see that big effect coming from there either. And then, of course, like Erik mentioned, because the industry finance is very regulated, the barriers to enter are high. On one hand, it is good. We all want our money and our payments to be safe. On the other hand, when you have a closed, regulated community, then of course renewal and challenge is more limited than in some other business areas.
And one other aspect to that is also that if you are a bank, you want your earnings to stay high and you're not too happy with competition in that sense. And the banks are strong, they have a lot of lawyers employed, they have compliance departments and so on. And if you then start a small firm with very limited financial resources, you don't have runway, i.e. you don't have time to wait. But the bank has. So what you can do is to start to simply challenge what they do on legal grounds and say, look, what you guys are doing is questionable. And that may or may not be right. Still, you play for time and they run out of funding and go down. And that is something that some of them that we spoke to in our study expressed, that they felt that their idea was revolutionary, but the banks would play time against them. And then, if they were right or wrong, that's not for us to judge, but they feel so.
And one of those disruption were, for example, PSD2, which opened up the APIs. So fintechs started emerging new solutions, new products, new services, enhancing the customer experience, etc. Would you say that in the close future, for example, the PSD3, will that create new disruption wave, or would it be also as a stepping stone for the banks?
Well, I think if we look of business areas where disruption is more probable than other areas, those would be business areas where there is simplicity. So the product needs to be simple. It cannot be very capital intensive. There should be high volume. And because of simplicity, it should be easy to automate, robotize. And if you look at payments as a business area, I think it fulfills all these criteria. So that is a potential area where the landscape can look different going forward. PSD2 did not revolutionize, you are quite right, it did not revolutionize in the way like maybe some people expected it would do. But this area that is payments is for sure something that is interesting for whoever will disrupt. Let it be fintechs or let it be big techs.
And I think if I look back 10 years ago or so, I was sent out in the world for the bank I worked for then and say, Erik, can you go out and scout a little bit, go to some conferences and find out what will disrupt us, please? So I went to Paris FinTech and New York FinTech and a number of other places with some colleagues of mine. And I remember we sat down with some coffee afterwards and we had the conclusion that, hey, isn't it so that of these people that we meet on all the stands there, 90% of them are about payments, 9% is about crowdfunding, and 1% it's about everything else. And that was that was 10 years ago. And if you look at what's happening now, that is payments is the area which is being broken into. Then crowdfunding is then one that is not happening in that way. And I think crowdfunding is interesting simply then because it looked feasible at the time, but then you actually also see some other of the downsides with that. And it didn't happen the same way.
I think if we look of revolutionary disruption, it is fair to say, maybe even surprising, but not when you think of it more, it will not happen in the Nordics. It will not start in the Nordics. With all the tech knowledge and with all the tech competence and enthusiasm that there is in the Nordic countries, I think existing banks and the infrastructure they provide is, well, good enough. And it works well. So it's very difficult to come and disrupt it. When we think of big techs and the potential areas where they would or could disrupt, we would be looking at regions where banking penetration is low, meaning that a relatively small share of people have a bank account to start with, and mobile penetration is high. More or less everyone would have a mobile phone. So we will be looking at emerging Asia, maybe South America, Brazil, these type of countries, low banking penetration, high mobile penetration. That is a fertile ground to test and roll out different type of payment, let's call them challengers or payment apps that can take the business away from traditional banks that really don't have it that much as per today. Then it might spill over and roll over to the Nordic countries in some day, but it will probably not start from here.
Now when we have set the scene, got the better understanding of the Nordic banking, we will jump straight to the white paper itself. Take attention to the one quotation you made on the white paper. So I highlighted, and I'm going to read it in quote unquote. The products Nordic banks offer today have relatively high level of digital maturity. So the question is for you now, is it a threat or is it an opportunity for the Nordic banks? Who wants to answer this one?
I think the question is very good.
You can start.
I can start. I think Nordic banks started digitalization and digitalizing before the word even existed as we understand it today. So we are going even to the 70s, but to the 80s and certainly to the 90s. So we are talking of decades back. And it has been a great advantage for Nordic banks. There are a few points, though. One is that cost control and cost cut was more a driving force than customer experience. If we look at other industries and new digital offerings, customer experience is usually the driving force. Easiness, quick solutions. For banks, it was cost control. The second thing is that this digital, or the wave of digitalization, it's probably coming a bit outdated. So that's the advantage and disadvantage of being a first mover.
Yeah, exactly. So the advantages are what Mikko mentioned. The disadvantages is then sort of first mover disadvantage. There are obviously some first mover advantages, but there are some disadvantages. And the problem is then that when you keep building on the systems that are now then 50 years old, and in many places you have layers of new systems on top of it, but things read back to databases in complex ways to sometimes software and databases that are 50 years old. And if you start a bank today in a country where you start directly on the cloud and you have no legacy at all, then that it can become a very big advantage for you. And in that sense, it's a disadvantage that you are stuck with old IT systems. It makes it very difficult to develop fast on that, and some of the products can't be done at all. In addition to IT, you also come with, there are legacies in many forms. IT is an obvious one, but you also have cultural legacy with how people think and work. And when you then try to make them work in another way, then you find places still today that simply don't want to be on cloud because there is a perception that is not safe, which that is not true. So then you can limit your selection of possible softwares to buy if you don't accept cloud, and then you are doomed to an existence of the B ranks of stuff, and that can be hard.
I've been in various dialogues with various banks in the Nordics, and majority of them, everybody's now in the phase of finalizing their strategies for the upcoming years, and I would say that this is a pretty good timing for your white paper to actually share those recommendations, the key findings, and let's say those kind of a to-do list for the banks to actually consider to make sure that they are future-proof or future-ready. A lot of these interesting words that everybody likes to use, of course. But you had kind of a 5 key items that you mentioned on this white paper. So if you take the first option, which is, in my personal opinion, probably one of the most important one, which is the getting the data and processes in order. So how crucial is this for the banks, in your opinion?
Yeah, well, it is dead crucial. First of all, data has to be right for a bank because it's about people's money. And like in some industries, it is not that dead crucial, but people don't want the account statement to be anything else than exactly what the money is and so on. So therefore, for the financial sector, getting data in order is of crucial importance at the very base in its own right. Then you have the usage of data, which is the second thing. And that comes to, when we were doing the report here, we interviewed between 30 and 40 C-level people and system providers, disruptors, regulators. And we made a point of asking most of them then, will you use a lot of AI going forward? Everybody was dead certain, yes, they would. But when you then ask exactly where and how, then people become less certain. But one thing is sure, without good data, there will be no good AI. So many of the things that people want to do in the future where they are not sure exactly what they're going to do, still the foundation is good data. So it can never be wrong to get your data right. That is one of the cornerstones, we believe. Or how would you see it?
Yes, I would. I completely agree. And you can take it even further and think of data in banks. Traditionally, banks have had data for risk management purposes, not for customer experience purposes. That is something more new in banks, that data is used for enhancing and improving customer experience. And here I think the financial sector is behind other sectors than what we have in the economy and the world around us. And the risk is, if banks don't get their data right, that the difference in customer experience from a data-driven perspective in the financial sector and other sectors is just going to increase in the future. So it's a very sure bet to put your data in order. Whatever the future is, you will need to have your data in order.
You know, if you think about it, I have been a senior manager in a bank. Mikko has even been a CEO. In times of capital scarcity, when capital was abundant and at zero cost, you could just deploy it anywhere, and you wouldn't have to care so much about customer profitability because you could just lend to anyone. But it is changing when capital becomes a question, and for many reasons, with CVA and the like and the cost of funding, the profitability of clients has become more in focus. And if you are in a management position that out there, then I have been, and Mikko has been, you are going to be asked, like, we have a certain amount of millions, or do you have this scarce limited capital to lend? Now, who is going to get it? Now, to be able to make the question of where should we deploy our scarce capital in the most efficient way, then you need to know customer profitability. That you can only do if you have data right. So if you don't have data right, you will also not be able to make good business decisions. And that's very crucial for banks. And that's very difficult right now because data is in so many sources. And data come in many forms. And when you look at the income and the profitability, you have the easy bit with income. Then you have less cost. Cost is more difficult because there's allocations. And then comes the very complicated cost of capital, which is insanely complex in its own right. And to get all this right is very difficult, but very crucial for good governance and maintenance. Not only risk management, but also making sound business decisions. And at the heart of all that lies good data.
And I think we should be fair to banks here. Like Erik said, it is not simple. There was a pizzeria down on the street outside the building here. It's fairly easy to understand what is the profitability of that pizzeria. If you go to a bank and have the question, what is the profitability of this customer? Well, it's not at all easy because you get a lot of questions, allocation of capital, allocation of risk capacity, allocation of funding, funding cost, and the like. So yes, to be fair, there is a reason why it's not so good as it should be.
Okay, there's one question or one aspect that you mentioned on the white paper is the ESG. Very important topic right now. Everybody likes to talk about it. There's a lot about ESG in the news as well. What's your opinion about the ESG in your key findings in the white paper?
Well, first of all, when we started to speak to people out there, it is quite clear that ESG is a mega trend that will shape finance or the whole world in the coming decades. And I think that the role of the financial markets is widely misunderstood. Because it is not what will happen if you want to efficiently. It's all about producing with limited pollution. And what you really want to do there is to steer towards the limited factor, which is pollution. And there is a place for that. It's called a marketplace, where you, with price signals, you steer resources towards the way of producing that will use that limited capacity the least. And if pollution is the limiting factor, then we need a mechanism to now steer production to the right places and away from the wrong places. It's in a very high level, it's quite simple. You need to get capital to the good and away from the bad places. The problem is that right now it is very hard to do that. You cannot simply enforce a regulation where they say, please make it more expensive to do bad things. You cannot really enforce that. I believe maybe that's one of the reasons that the politicians are now on a journey to regulate data. And for example, ESG data will be reported under Pillar 3 for banks of a certain size. That will drive the fact that a couple of years from now, when that cycle has gone and when ESG data is available also for smaller banks, it will be measurability around this. So at some point, it will be possible to enforce a regulation that if you lend money to something that will lead to pollution of more than X grams per ton, you have to put on another 5 basis point on that. That's when you can actually start to use the market to steer capital. That is the so-called marketplace, and marketplaces will be used to solve the global warming problem. Banks run marketplaces. So banks and the financial sector will be used for the green transition. And that is not generally understood by people out there. They think banks are greedy or this and that, but it is a channeling source, a plumbing system, and it can be used extremely efficiently to get the most rescuing of the climate out of the least resources tied up. If you think about it from the little consumer's point of view, people believe that they want to sort their trash. That may have an impact, but there are people that argue that the single biggest impact that you can have is if you could decide how your pension capital is allocated. If all people out there could deselect bad things from pension, a lot of sectors would go out of funding very quickly. So to be able to orchestrate and invest in this entire infrastructure around this is going to be an investment that will have to be made.
I think if we look at individual consumers, people, the average person on the street, when you interview them, they will have very strong views and feelings and how things should be made better. When you follow them to the supermarket or to the shopping mall and see what they do and why they buy and how much unnecessary they buy, there's a mismatch between what they say and what they do. If we look at politicians, well, they have not really demonstrated the best of what they could do in taking action in this area for a lot of reasons, good and some bad, some good, but it becomes very difficult. I think the financial sector will have a bigger role and a bigger power in the future. Maybe it will become even more powerful than than many or some would like the sector to have, but it will. The footprint of the financial sector in itself is very low. I mean, it consumes electricity, it's in an office building, and people commute to office, and that's about it. But like Erik said, the transfer of assets from one place to another goes through the financial sector, it goes through the marketplace, and that's then again, on the other hand, everything that happens in the economy.
In your professional experience, now you have been working with the banks quite a long time. How do you see the banking right now? Are they taking already kind of a good steps towards getting their data in order, or is still a little bit lacking behind? They're not making right investments or investing the hours, the resources, or capital to make proper changes that it requires?
Yeah, I think, they do know what the problem is, and they have taken action. Sort of that is fair to say, and there has been a lot of advancement. So we have to be fair again. What is important to keep in mind is that these are big transformational projects. So it's not going to be a year or two to get them in order. One needs to think over a longer period of time for a transformation, and it is a technical transformation, but it is also a cultural transformation. This is happening. Could it happen faster? Yes, preferably so. Can banks manage on their own? Maybe not everyone. Maybe they need some help. But whoever is first there is going to have an advantage over the others.
Now we have talked about fantastic piece of work that the guys have done around Nordic Banking 2033. Now we're going to jump to the key conclusions and key findings about the report. Most importantly, now when we're discussing with the banks, we see the same trend that the IT is pretty much every day, every task that we do around it. So basically, even basic banker, he needs to know and talk IT these days. So you need to understand about the data, you need to understand the AI, you need to understand the generative AI, many other these hot topics around information technology, basically. So we're talking about the customer experience and so forth. So now the bankers not only need to understand the economics, but it also need to understand the IT. And one of your findings were in the white paper that you need to rethink the IT is one of the recommendations. So how banks should kind of a balance between the business and IT?
There are many sort of ways to view that question. So one is sort of organizational. You simply some time ago, like years or decades ago, or whatever, depends on what bank. But you can have traditionally you would have the business and you would have IT, and they would report different ways, and they would meet only at the CEO level, and then it becomes very difficult to work together and understand them. And as banking has become IT already, what we advocate is that you break that IT up. Into sort of the traditional IT, which keeps the printers printing, more of the plumbing of the bank. But then the majority of the IT people in the bank, if you call them IT, should be broken out and paired in with the business so that they are very close, maybe even report to. And some banks have come a long way in this, others have come less far. But I think it's quite clear that you need to rethink how you organize IT to get them closer to the business, to be able to shorten the development cycles. Otherwise, you're doomed to this waterfall existence where things will be so slow that you simply will not be able to keep up. And that is sort of the organizational view. Then you have also a psychological view that you need to upgrade people, and you need to. One of the sort of capacities that we find, both of us in the study and in the discussions, is that banks lack this kind of multi-talented individuals that both. It is not enough to hire one person that knows business and another guy that knows IT. You need that knowledge in the one and same brain, because it's in there where the connections are really made fast and where you start to see things overlapping. And that kind of individuals that know both, they have a strong and long track record in business, and they also understand the technological trade-offs. There are very few of them of that kind of individuals. The same goes then for ESG. You have people that know banking and you have people that know ESG, but there are very few individuals, and there's a handful of faces in front of me now that I see now that actually know both. And we think that banks are going to have to invest. I think Mikko I have a business background, so Mikko usually makes fun of me, and he says that, Erik, it's easier to take the tech guys and teach them business than to take the business guys and teach them tech. But we believe that the banks are going to have to make an investment in that skill set simply by deploying talented people on the other side of the fence for a while and making people move across, so that over time, and that's a trade-off, because sometimes it means that you will take the most talented business guy you have right now and take him out of production so that momentarily you will have a less productive environment because that guy is now over in IT or tech, learning something new. So the next quarter, you will be better off having him here or her here. But in the long run, you need to accept that to educate your workforce. And then you also need to be long-term with that, because once you're done educating them, somebody else is going to try to steal them.
That's absolutely the case. The people are not out there to be recruited. So banks need to educate themselves. And bringing IT and business together, when we say that, we think further than just bringing them in the same meeting room and putting them, because they will speak the different language, they will have a different frequency to talk. So to have the one and the same person who knows both, that's going to be an asset. And if somebody is thinking of a career move, I think these kind of positions where you actually acquire knowledge of both will be very, very sought after in the future.
For here on, there is a couple other action items. So I'm going to definitely write them, or going to spell it out for you as well, because they're very interesting in my opinion as well. So in the white paper, you also emphasize the importance of going greenfield and being ESG ready. I know, Erik, this is your favorite topic. So how can the banks navigate these challenges and position themselves for success in an evolving landscape?
If you start with the greenfield question, so by greenfield in this case we mean that you start over. So one of the challenges for the industry is that it is always safer here and now to just add a little bit to what you have. Then if you think about other industries, like music industry, you've had a shift from, there were cassettes, then there were CDs, then there were iPods, and now you stream music. So at least on 4 occasions, you have completely sort of moved on to new technology and you have killed off the old. What has happened in many of the banks is that you simply have kept developing on the old, like into eternity. So you never actually killed it off. You even have a worse situation that you start off something new, but then you're forced to keep the old. So in the music industry example, you don't have all of these living in parallel now. The other ones are not produced anymore. I'm sure there is the odd LP being done still, but generally it is not done. But in the banks, you often have the new system, and then you migrate some clients, but you couldn't fully migrate them, so you are now left with both. That we see sometimes. So when we talk about this, we advocate move to a new, develop a new system when you can, move the data or the activities, then test that it works, and then kill off the old system, like decommission it. Never allowed any connectivity back to the old one. And this planning of killing the old system has to start very early. Because what is easy is to move the first few clients. It is quite common, it is known as the long tail of clients. It is quite easy when you have a new system to migrate 90% of the clients. Then the next 9 can be migrated with some effort. And then you're left with that 1%. And then you find out that they can't be migrated because there is some reason for that. Try to find out super early and address that really heads on. Otherwise, you might be stuck with multiple systems. Worst is that they are in some old COBOL where you can't find programmers. And we have seen cases where people simply have to pull people out of retirement back to work to help out to understand what had been going on there. That is costly.
If you think of processes, in banks, processes have been developed from a risk perspective, risk management perspective. If we think of delivering food home, and there is a process. You order the food and then the food comes home. But if that was taken into a banking perspective, I guess it would go in some way like that. When you call the restaurant and ask for the food, the restaurant is going to run a long list of questions to you. Are you eligible to order this food? Do you have these allergies? Are you sort of underweight or overweight? Or is this food something you like or you don't like? And then when they have come to the conclusion that you are eligible to order this food, then we need to make sure that the restaurant always has a good stock of that food. Not too much, not too little, but a good stock. Food waste has to be 0. Then comes the transport, then comes the delivery, how the delivery guy or girl comes to your door. Is it secure? How can they be sure that when you open the door, you're not going to sort of misuse them or abuse them? So I mean, the food order process can be made really difficult if it was made as a process in banks have been made. Now that of course leads to that the customer experience of ordering food is very different than your banking experience. And I guess that's fair enough, but then the average consumer is comparing these and they will be always left with the feeling that, gosh, isn't it difficult to take care of your finance and isn't it difficult to be in contact with these insurance companies and whatnot? So this is a challenge to finance as an industry, how to make it feel as easy as ordering food, because yes, I guess we are all okay with that 1 out of 100 people, or what would be a good number, I don't know, 1 out of 1,000 people might get an upset stomach because of some food, but we will not be okay if 1 out of 1,000 people lose their money from their bank account. So there's a reason, but the feeling has to be generated to the consumer.
Mm. From that perspective, the greenfield and also concentrating on the user experience, should banks kind of take more risks to provide services and solutions which are more of a tech-savvy or kind of on the frontier of the digitalization and start challenging with the big techs? Or should they play safe?
I think greenfield is everything is a risk. If you are polishing the old system, that is a risk. If you build something completely new, that is a risk. But I think in order to be relevant in tomorrow's game, on tomorrow's playground, it is worth considering to build completely from scratch and rethink the whole process, what is really needed and what is not needed, and then as soon as possible sunset the existing systems.
Sometimes when it comes to this, it's worth highlighting the opposite. In a thought experiment, you ask people, what is the cost of doing something? Well, the cost is whatever, something. And then you say, okay, so that's very expensive, let's not do it. So what's then the cost of not doing anything? And often you come to a conclusion that in the short term, the cost isn't so high. Actually quite good. We don't spend any money and we don't do anything much this year. And next year, we are still roughly competitive. Maybe we lose a few clients, but it's still okay. So if the conclusion is then in a year, we don't do much. If the conclusion is to continue that strategy for the next 10 years, so not doing anything any year for the next 10 years, that means doing nothing for 10 years. Then you're certainly going to be in deep problems 10 years from now. And it's really important to understand this concept of incremental improvement. You need to, it's a bit like training. You have to go to the gym at least a couple of times a week, even if you cannot pinpoint exactly on what day you became a bit more fit. Because if you don't do it, you certainly won't be fit in 10 years. And I think that it's worth thinking about that sometimes, that the cost of doing nothing can be a lot higher, and the risk of doing nothing can be the highest of all. So this risk of doing something, sure, but what's the risk of doing nothing?
Good. And if we kind of start wrapping this up, if we look to the year 2033, like in your white paper, the title says, so how will the bank look like, in your opinion? It will be IT development company, or is it a bank which provides services, solutions, or what kind of a setup you see that 2033 will look like? How the bank will look like?
In the big picture, I think it will look the same as today. Banks will be banks. Business will be taken care of. Some areas can be disrupted, like payments and other simple areas, uncollateralized lending, for example, simple investments. Banks might be more focused than what they now are. That can be geographically, product-wise, customer segment-wise. We can have big techs that are disrupting, maybe not in the Nordics, maybe they have not started from the Nordics, but that can be happening, so I would keep a close eye on that. I would then also hope that big transformation projects have advanced well. Banks will try to hold on to the full value chain from the customer to the finest detail of the operation. At least we didn't come across any player in the market who thought they will become only a back-end provider or only a front-end provider. So these are a few thoughts that come to mind.
And I think it depends on what kind of segment you talk in banking. If you're talking about retail banking or private banking or corporate banking or asset management or what. But I think in the open banking is one area that's here to stay. And what we see a lot in our work is a willingness to connect systems across, so that the banks with the APIs connect directly to the corporate treasuries and so on, so that you can, instead of having people, you can sort of immediately get your transaction done at the point in when a need arises to order like new tires, or for example, then the frontline manager of that place that need a tire will look in the ERP system, and then they will already at that point get the question on what currency they want to buy the tires in through the ERP system. So there will be different distribution models, partly where they think the banks will be challenged a little bit, where somebody else is going to try to steal some of the interface, partly to get the data, but also it makes a lot of sense to interconnect the systems because you can reduce friction and cut on back office and many other things. So I think open banking and the platforms related to that are going to be important.
All right. Absolutely fantastic. All right. I would say that this is the time that we have today. I'm very pleased that you have you in our first episode of Composable Banking podcast. It's great to have you. Great people, great backgrounds, and fantastic work with your white paper. Very pleased to read that. And if you readers or listeners, you haven't read the white paper yet, please follow the shared link, etc. We're going to share that and also take it to your site as well, so you can download it from there. And hopefully we're going to see you next episode as well. So thank you very much, Erik and Mikko, that you joined us today. Hopefully see you again soon.
Thank you.
Thank you very much.